Well, good morning, everyone, or good early afternoon, depending on where you are. I'm Keith Harrington, co-founder and COO of Novel Capital. We are a fintech platform, and we provide non-dilutive capital to B2B SaaS businesses throughout the US. We're a little bit unique in that we are venture-backed, having raised more than $15 million from Ulu Ventures, Ignia Ventures, MatterScale, and others. And we've also raised another 120, $130 million of capital that we can loan out to our companies. So we've raised debt, we've raised equity, we're always raising money. So we have, I think, a unique perspective on the topic today. We've provided capital to more than 130 companies, totaling almost $100 million. And I'm really excited to talk about this topic today and to share some insights about how we think about due diligence from the lender perspective, and also about my experience raising capital and going through the diligence process. And I think hopefully what Christian and I have the opportunity to share today will help you sort of sail through the diligence process when and if you decide that you need to go out and raise capital. Before we get too deep into it, just please note that you can use the Q&A function at the bottom of the Zoom window. And Sophia from the Novel team, who's also here, will help us make sure that we get those questions answered, unless they're super hard, in which case we'll probably skip them, but that'll be fine. So with that said, I'm going to go ahead and get started. With me today, I have Christian Marquez, who is the CEO and founder of Finstrat Management. Finstrat actually raised capital from us at Novel. And so what's really interesting is I can share with you that the diligence process was super smooth. And I think that there's a very good reason for that. And the reason is that Christian and Finstrat actually provide expert CFO, accounting and finance, and reporting services for AI companies, SaaS companies, venture-backed companies around the country. So they kind of know what it takes to raise capital. They know what investors and lenders are looking for. And again, I can attest to the work that they did to present the business to us at Novel. Made it extraordinarily easy for us to get from the point where we had questions about the business to understanding the business to decisioning on some capital. So, Christian, great to see you as always.
Keith, good morning. Super excited for this webinar today. There's going to be some great information that comes out of this, I know.
Yeah, I think so. Sorry for taking up so much air at the beginning. Let's actually get started. Tell us a little bit about Finstrat. Why you do it, and tell us about how you actually help the businesses that you're helping.
Yeah, happy to provide some context for the benefit of the audience. So as Keith mentioned, Finstrat Management provides CFO-led accounting and finance services. We work predominantly with founders, entrepreneurs who've started early stage companies, and predominantly they're investor backed. By consequence, this is a lot of SaaS, now AI, but we've also been exposed to and work with companies that are selling hardware and professional services as well. On a side note, we are a bit unique, and then our client base also includes investors, high net worth individuals, family offices, as well as venture capital firms. The way I like to describe it is Finstrat operates at the intersection of shared interests between founders and investors. But as I mentioned, pertinent for this call, because we are in this unique place where we straddle the fence and have the perspective of both founder and investors. And, as you'll see as we go through this call, each group, while they have similar objectives, increasing the enterprise value and getting a return on their capital, a little bit different take at how we go about that. And we'll unpack today steps that founders can take that they increase the probability that they can raise capital, whether it's debt or equity, from investors.
On that note, everybody knows that when they go out to raise capital, for whatever reason they decide to go out to raise capital, and we could talk a little bit about different reasons and rationales later, but everybody knows sort of in the abstract, they need to have their financials buttoned up. They kind of need to have their act together when they show up in front of an investor. But not everybody really knows what that means. In other words, not everybody knows exactly what investors or lenders are going to be looking for. So I'm curious, when you are working with your clients and you're going out, you're helping them get ready to raise capital, what are the things that you need to help them prepare for, we'll start with equity providers, and we can get to debt to lenders next, but because they look at things differently, some the same, but there is some difference. But I'm
Yep.
curious, what are you helping them get ready when they go out to raise equity?
Yeah, so we're coming up on 8 years of history. During this time, we've collectively assisted our clients close over $250 million in financing, so debt, equity, as well as sales of their business. And there's an underlying premise that, I always seek to impress on a founder, and that is, please appreciate that every investor is really thinking about two things when they give you their money. They're thinking about return, but they're also thinking about risk. And so any decision of whether you're going to invest, whether it's in a private early stage company or a public stock like Tesla, or Google, there's going to be a consideration of how am I going to generate a return on this investment, but also what's my downside. And so this concept of risk manifests itself in due diligence. So in the setting of equity, as compared to debt, equity investors are have no right per se to get a return of their capital. As a consequence, they want a lot of upside.
I want to stop you there, Christian, and I want you to say that again because that is something that I don't think everybody fully appreciates. Say that again and explain it a little bit.
So as we'll hear here, equity and debt investors have different mindsets. An equity investor is uh, seeking to purchase a share of the company for all intents and purposes for unlimited upside. The value of that company could technically increase exponentially to the point that they go public. And depending on the percentage of the company that they own, at the time that that investment monetizes, they would be entitled to a percentage of the value of the company. The flip side of that is for if the unfortunate reason the company goes out of business, they don't get their capital back. All right. So they're exchanging a lot of risk for a significant amount of upside. And so if you think about the risk of not getting your capital back, they conduct due diligence. Due diligence can be quantitative and it could be qualitative. Quantitative, as we'll talk about today, can be very objective. Hey, let's look at the company's financial statements and your performance metrics. Qualitative can be, hey, I want to meet the founders or the C-suite. I want to understand the total addressable market that the company's product or service addresses. But as we unpack those different measures, ultimately, an equity investor is seeking to answer the question, what is my potential upside, but also what's my risk? Are founders first-time founders? Are they repeat founders? Arguably, if this isn't their first rodeo, odds are higher that they'll know how to better navigate the invariable challenges that come up when you're seeking to scale a business. And so, so that's equity. Debt, a little bit different. So most debt lenders include covenants. Covenants vary, and I'll actually let Keith talk a little bit about his perspective, especially as it pertains to Novel. But it includes covenants, collateral as an example. But effectively, in the agreement, they're generally going to be first in line to get reimbursed for their financing that they provide. And so if you think about it, the mindset's a little bit different. They know exactly what their return is going to be, principal plus interest, but they also know what their risk is. And they're a little bit better positioned than equity in return for the fact that they're not taking as much upside. And so their due diligence, as Keith can share with you, a little bit different. They're looking at what is the company's ability to pay or repay the principal plus interest in the short term, in addition to some of the qualitative aspects I mentioned a moment ago.
One of the things that I think is interesting and perhaps a little bit nuanced, but I want to dig into it just a little bit, is it kind of differs depending on the stage of the business, right? Um, if you're a pre-seed company or a seed stage company and you're going to go out to raise capital, you need a certain set of things for an investor to be comfortable. But if you're Series A and beyond, then you have to have a different set of things, a much more sophisticated set of things. Your specialty is really Series A and beyond. Is that correct? The
Majority of our clients are doing at least $1 million in trailing 12 months, which puts them in the seed. Number
See,
of clients who've closed A, handful of B.
okay.
But I would tell you our sweet spot, just for context, is as businesses start to approach something that looks like product market fit and
Mhm.
require high touch. So you start to introduce programs like Stripe and Maxio, in addition to leveraging your CRM, whether it's HubSpot or Salesforce, in order to grow your top line.
What are the key ways that you think that CEOs need to be thinking about the difference between raising at that, you know, coming at $1 million in revenue and then getting beyond that? Those things change. What are the key things that they need to be thinking about?
Yeah, so one of the things I like to do is I like to identify the opposites or the extremes in order to make a point. So if you think about when a company is pre-revenue, generally
Mhm.
speaking, you're going to go families and friends. Family and friends are unsophisticated investors and aren't going to conduct any due diligence other than to say, "Hey, do I like you?"
Speak for yourself.
On the
Okay.
on the other end, imagine going to your IPO. You're going to hire an investment banker. You're going to engage the SEC, and there are no shortage of hoops that they're going to jump before they allow you to list your shares on a public stock exchange.
Right,
And
right.
so if you imagine those two poles as the company progresses from safe notes to a seed round to a series A, B, et cetera, the amount of attention, subsequent due diligence that the investor is going to do increases. For purposes of this call, if we're talking about Series Seed, Series A, really the emphasis is going to be on financials, performance metrics,
Mhm.
in addition to the qualitative aspects of help me understand what the founding team is, what their experience has been, and what market and problem are you solving. Sophistication varies. Generally speaking, you'll have a lead investor in the setting of equity. Lead investor is the one who's generally going to take the responsibility for doing most of the due diligence lifting, and their co-investors will default to the lead investor's decision of whether or not they're going to invest. And so for practical purposes, for anyone who's thinking about doing a Series A, it's really important that you identify a lead investor, that person who's going to do the majority of lifting, because not every investor who participates in A rounds simply has the manpower to be able to conduct due diligence. And so their MO is, hey, I always co-participate. I never lead. So a little bit in the weeds, but important distinction to make sure that, when the time comes that you're going to raise a Series A plus round, that you're looking for someone to lead the round.
I I want to actually get people to weigh in here. Click the raise hand button. I assume everybody has the raise hand button. If you're preparing to raise capital right now. Okay, two, three, four. Okay, good, good. All right, so Andy, Joel, Peter, and Andreas. And then there's a floating hand that went up at some point there that I don't understand. Um, okay. Um, so now raise your hand if you've raised capital before. Still Joel, Shiva. Okay, now final question. Raise your hand if due diligence was easy. Okay, one. All right. Yeah. Okay. I just wanted to get a sense for, where everybody is in their own journey, and it kind of mirrors what I expected, which is there are some folks who are preparing to raise capital. There are some folks who have raised capital. That helps make sure that we keep the conversation on point. One other quick thing, please don't be shy about asking questions. Happy to answer anything that any of you are curious about as we continue. So one of the things, Christian, that you and I have talked about a lot actually is what does it look like to be able to actually provide clean
Yeah.
financials, and what does that look like? And you actually, actually the framework that you've shared with me before has helped me think about diligence in a new way. But there's clean financials and there's performance metrics. They're interrelated. And those are the things that investors and lenders are going to look at, right? How do you counsel CEOs to think about and deliver those things in a way that conveys confidence to the investors?
Yeah, great question. And so I find that it helps to begin with the end in mind. So let's say you've identified an investor who's expressed interest in learning more about the opportunity in your company. One of the things that a lot of investors are going to do is they have benchmarks. They have their own growth benchmarks. They have gross margin benchmarks. They have benchmarks of how much money that you're spending on product development and sales and marketing. These are fixed. They do change over time, depending on a whole host of factors. But I could share with you now today, as we're recording this in December 2024, we're now in a no longer zero interest rate policy environment. Fed started increasing rates back in Q1 of 2022. That's changed the risk profile of a lot of investors. And so now what I see from where I sit and talking to our clients and other investors in our network is that they've increased their thresholds for what they look for in terms of growth rates. They've increased the gross margins that they're looking for businesses that are selling software. They want to see that companies are now at least break even, if not in the black. And so starting point is just this concept of decisions are not necessarily or multivariate, but they're not arbitrary when it comes to financial metrics. It's this understanding that depending on who you're talking to, they're going to have their own opinions as to what your financial profile should look like. Now, I rattled off some examples, and so I'll just walk down a P&L. But starting at the top, revenue, effectively an indication of what is the fit between your product or service and your market. And you're going to want to see a growth rate. But a semi-sophisticated investor is also going to unpack your growth rate. They're going to want to see, let me see your new sales. Let me see your expansion sales. So this is sales from existing clients. Let me see your churn, whether it's gross churn or net churn. Let me see retention. And this tells a story. We could probably devote an entire podcast on the individual components of reoccurring revenue. But the idea is you have to be able to calculate all of these metrics, and I'll come to that in a moment. But we invariably see that MRR, ARR, and its subcomponents are absolutely a crucial set of metrics that any investor is going to look at, and in particular once you get to Series A. Other big one is gross margin. So this is going to be your percentage of profit subtracting cost of sales. Part of the logic, especially for software, now AI-based companies, is that they're looking for at least, let's call it north of 60, but closer to 80% of gross margins. And the idea here is that eventually when these businesses get acquired, they're going to eliminate all the operating expense. And they just want that revenue and the expense associated with closing those sales. And so having gross margin that's between 60 and 80% tells them that they're on a path where they can see a material return on their investment. I mentioned benchmarks around product development, sales, and marketing. So this is operating expenses, generally broken up into three buckets: product development, sales and marketing, and general administrative. Everything I just rattled off can be benchmarked. There's no shortage of third-party services that offer benchmarks for private companies. Generally speaking, depending on the stage of the business, but if this is early stage, you really have to be able to tell a story of whether or not you are overweight or underweight product development or sales and marketing.
Right.
My experience has been is that it is industry dependent. It's also dependent whether you're B2B or B2C. But at least knowing how much you're spending relative to your peers is valuable so that you could be prepared to explain to an investor why you've made that decision. And then last but not least, EBITDA, or whether or not you're break even. Many of the investors who I speak with for companies who are preparing for Series A, their mindset has changed. Capital is not as readily available unless you're selling AI. More on that in a minute. And so what I see and what other investors tell me is that they're looking for better capital efficiency. Show me
Mhm.
that I don't have to worry about you running to me in a year or 18 months for additional cash.
Right.
And so there are additional metrics that we could unpack. Customer acquisition payback period is a good one, rule of 40, that touch on the variables I just mentioned.
Hmm.
But for purposes of this conversation, I'd say revenue, gross margin, bottom line are really valuable starting points to have a good handle. Um,
Yeah. I would totally agree from our perspective as a lender. Um, a good portion of the way that we analyze a company depends on those three metrics and the underlying dynamics of those three metrics. You've mentioned benchmarks a couple of times, and this is always something that I found to be a little bit challenging. We at Novel, we're a particular kind of business, right? We're a fintech, we're a lender. It's kind of a weird business, I guess, if you think about it. It's not SaaS, and it's just so there's not a whole lot of readily available benchmarking out there. We had to do a bunch of research to figure out what should the benchmarks be that we're paying attention to and that we think investors are paying attention to. Um, but maybe that's a good thing to share. Where do you go for benchmarks? Where do you tell your founders, hey, these are the things that you should be paying attention to? What are the
um,
sources?
yeah, so one of the things that we can do is for the show notes is we'll include links for a whole host of third parties out there
Great.
that free but also paid benchmarks. Um, but I'll let everyone in a little secret in the spirit of here of trying to give as much value as we can. Um, the SEC, so if you're a public SaaS company or any business for that matter, you have to file quarterly, annual, and a whole host of other reports
Mhm.
with the regulatory agency. I 100% acknowledge they're public; they're not private companies. However, if you've never taken the opportunity to read through their quarterly or annual reports, they're phenomenal sources of information because they're sharing their own insights into individual markets. But this part's also really valuable. You'll see that the P&L and balance sheet setup for these public companies are effectively identical. This brings us back to a point that is very pertinent for our audience is, being able to calculate MRR, gross margin, and EBITDA is great, but you need a starting point.
Mhm.
And in our experience, today we've worked with nearly 100 early stage businesses over the preceding 8 years, almost without fail. I would tell you 99% of our clients come to us with a set of financials that are in desperate need of TLC. And so if you're in that boat, you're not alone.
Yeah.
And I say that because, there is value in investing in organizing your financials in a specific manner that investors are anticipating, even as early as a Series A. Um, and one of the things we can do after this, I'm happy, Keith, we'll post a link to just a standard template that we use for our clients
Oh, great.
that explicitly breaks out revenue, cost of sales, product development, sales and marketing, and G&A. And so, this is valuable in so much as that it gives you're able to benchmark, but more importantly, you're able to now calculate metrics. Because one of the things that we invariably see is, hey, I've run payroll and I have to make my payroll journal entry, but everybody gets lumped together in one set of accounts
Mhm.
versus, hey, let me separate out client success and put them in cost of sales or sales
Right.
and or offering bonuses. Let me break out my developers and put them in product development or the C-suite and put them in G&A. Really, really important because if you didn't do that, and you go to look at your sales and marketing expenses, arguably you're going to not tell the right story as to how long it takes you to recoup money that you spent to acquire a new client. And a sophisticated investor, I'll tell you, definitely at a Series B, but more so on an A, they're going to look at this. And so, I joke, but I vaguely remember elementary school and the teacher saying "GIGO." So this is like early 80s. I'm like, what's GIGO? Garbage in, garbage out. Now I understand. I was like, oh,
Right.
financials and dashboards are only as good as how well you can accrue the underlying revenue and expenses and um, classify, charges and items that are hitting your financials. And so, look, this is what we do for a living. I admit I'm biased, but I can't. I tell you, today, majority of our business comes from investor referrals.
Yeah.
Partners or board members, here are CFOs, and they say, "Hey, Christian, I need you to talk to so and so because they're getting ready to raise a round," and we know that they need a set of financials because that's the stepping point for models and dashboards.
And I think, I mean, I can amplify that point just a little bit. I see we have a question. I'm going to say, I just want to get this before I forget it. But you said it makes sense to invest in making sure that you have financials. From our point of view as a lender, not having financials ready or not having them timely or not having them make sense, having them disorganized is a pretty bad signal. We're always looking for financials that we can trust. And the moment that we see something on a set of financial statements that doesn't line up, things don't reconcile, something that causes us to say, wait a minute, that doesn't make sense, things slow down. And that can be really problematic in a deal, whether you're talking to us as a lender or any other lender, or you're talking to a VC. I can say the same thing. I used to be a VC. I can say the same thing on behalf of my VC friends. If you can't trust the financials, things just slow down. And when things slow down, things get really. I perceive slowing a deal down as a threat. People say time kills all deals, and it's true. I mean, it's not 100% true, but it happens when things slow down and time gets elongated for whatever reason. Then your chances of actually closing that deal actually diminish. And so, my perspective, certainly as a lender and also as a person who's out raising capital, not infrequently, is we have to have financials ready to go, believable. And when I'm out raising capital, I have to be able to talk about them. And I have to be able to walk through them intelligently. And I may not be able to answer all the questions, but most of them. And that's an absolutely critical part of being out on the fundraising trail. Um,
And I'll tag on to that. So very practically, my counsel that I would offer our audience is have one source of truth.
yeah.
So one of the things that I hear from talking to investors is they'll receive a set of financials, and then they get a pitch deck, and the numbers don't tie out,
Yeah.
and it's a problem because they don't know what to make of it. Did I just get the wrong version, or do you not have control over your financial processes? And so really, really important. Our opinion is that accounting platform, whether it's QuickBooks, Xero, NetSuite, Microsoft Dynamics, take your pick, that should have a tremendous amount of integrity. Now, I'll
Mhm.
be the first to tell you, it's not always necessarily that easy. We have a lot of clients who run invoices and payments in Stripe, in HubSpot, in Salesforce. And so if as the business grows in complexity, the most important point is to have controls in place to ensure that as everything rolls into your accounting platform, that it's being QA'd at least monthly. Because one of the easy and look, fraud does not happen all that often, but it doesn't mean investors, they don't verify.
Right.
Semi-sophisticated investors are going to say, give me your bank statements and let me check your ending balance. And if they
Yep.
tie, hey, that's great. And if they don't, there better be a really good reason
That's right.
to why that.
That's one of the key things that we see that slow deals down. Things don't reconcile, and balance sheet reconciling to bank statements. That if that doesn't connect, then we have to stop and scratch our heads and say, okay, what's going on here? Why the mistake? Why doesn't this line up? That if the financials are months behind, if there's a significant lag in getting the data out
Yep.
and presented, that can be a significant issue from the perspective of a capital provider. And something that I think everybody needs to understand out on the fundraising trail is if you have volatility in your key metrics like sales growth, like look, it's not always going to be perfectly up and to the right, right? As much as we'd love to believe that it is. Sometimes it's very volatile. If it's random and you can't explain it, then that's going to make raising capital more difficult. If the volatility is something that you understand and can explain, then it's going to be it's not necessarily going to make it easier, but it's a hurdle that's there that you can clear. But the fact of the matter is, you have to have a good story and data and facts to back up why the volatility exists and how maybe that's just how the business is, and maybe that's how it's going to be going forward. And it's just one of those things you have to be prepared to talk about. Otherwise, the conclusion of a capital provider might be that you don't understand the dynamics of your business, you don't understand the key drivers of your business, and maybe we just have to wait and see how it goes for the next 6 months, 12 months before I, as a capital provider, will be able to help this business.
That's right.
Um,
Yep.
Sophia, we have a question. Do you want to ask it?
Yes, actually, Joel gave us a really good question here that says, what do SaaS business typically include in their CEO's GS? Any cheating there? Probably.
Any
Um,
cheating?
You let us know.
What
Yeah.
do you mean by cheating?
so, happy to answer the question. So, let's define COGS, cost of goods sold, or just cost of sales. So, the spirit of the line item cost of sales is expense explicitly incurred as a result of the sale. And so, in no particular order, an example would be let's say you have your solution includes an AWS server specifically for hosting that client. I'm not talking about a dev environment. That expense would only be incurred because you have revenue that supports it. If you have customer success staff who have been explicitly hired to assist with this delivery of your service or product, they would show up there. Now, it's tongue-in-cheek cheating. I understand. So for the benefit of our entire audience, let's unpack this because this is, I think, the reason why it was asked. There is debate amongst founders and boards and investors of all expenses
Yeah.
show up in cost of sales. So a moment ago, I referenced customer success staff. Well, there's a group of people who would say, well, if my customer success staff receive a bonus for retention, I can argue that they're effectively sales and marketing, particularly if I give them sales and marketing training. So, Christian, it would be more appropriate for me to include them in my sales and marketing line item in OpEx versus cost of sales. Commissions are another example. If you only pay out a commission because you close a deal, you can argue that you've only incurred that expense because of the revenue. It should show up in cost of sales. But there's a group of people out there who will tell you no. This is explicitly sales and marketing expense, and it should show up in my sales and marketing payroll commission line items. Most important is the treatment and being consistent. So we go through audits for our clients all the time, passed every single one. I don't know how I've lost track, dozens. And the most important thing an auditor is going to look at is have you consistently applied your rules over time? And so now that said, can you game the system? Sure. And in the examples that I was using before, you may have better gross margins, but your customer acquisition your CAC is going to be higher because your sales and marketing line items a lot higher. So it's almost like a whack-a-mole, depending on the expense, in so much as, if you spent the money, it's going to show up someplace. It's going to show up in your gross margins, it's going to show up in your returns, or it's going to show up in your bottom line. So what I think is most important is just being consistent than it is trying to game your metrics.
And being consistent and having a logical explanation for what you're classifying as COGS or not. We see that all the time. We see different kinds of businesses that allocate different expenses to, as you said, in their sales and marketing expense line versus COGS up above. And sometimes we adjust the financials to make it to sort of normalize for our underwriting process. We don't take issue with how people categorize it, but we will normalize so that it aligns with our models the way that we need it to. But it is interesting to see how people think about it sometimes. I have a business with 100% margins. Okay, well, we may take a look at that. That may just be maybe you do, but maybe we should take a quick look at that. I think thank you for the question, by the way. Please feel free to keep asking questions all you'd like. Um, I think there's another point that I know your companies are dealing with on a regular basis, right? And that is growth. Growth is great, but growth presents all kinds of challenges, and every founder on this call knows that growth breaks your systems, right? The systems that you built and that run your business at 500K in revenue break, and you get to 1 million and they break, and then you get to 3 million and they break, and you get to 5 million and then they break, and it just keeps going and going. So you have to reinvent the systems, and those systems are up and down the stack, right? They're your finance and accounting systems, they're your customer acquisition systems. Everything that you do has to continually be reinvented, and I think that's not uncommon to see finance and accounting sort of lag, right? Because it's not the sexy thing that grows the business, so to speak. It's not the thing that is going to drive, at least from I think that the perception is it's not going to drive a lot of value. So it'll lag and will catch up eventually. But the problem is if your financial systems are broken, then it's going to be very difficult to get capital when you want it and when you need it. So to me, scaling is a very particular and unique challenge all the way across the business. And I think, like I said, if finance and accounting and financial systems lag, then it's a real bummer when you find that out when you're on the fundraising trail, right? And your financials start getting picked apart because they're not up to snuff. So I imagine your companies are seeing this all the time. This is your job, right? How do
Right.
you help them stay in front of that?
Yeah, so there's there's I've already alluded to some of the core systems. I'll unpack them here in a
Mhm.
moment. But then there's also another consideration, that's your reporting package that sits on top of your accounting records. So let's start with accounting records. We can distill everything down into three core platforms. Some of them may be consolidated depending on who you're using. Number one is going to be your accounting platform. Intuit owns 75% of the early stage market,
Mhm.
so we see almost everybody's on QuickBooks Online. We are big fans. On a complete side note, I'm gonna offer up my vision. There are now a whole host of QuickBooks Online competitors who are coming out with AI automated solutions.
Mhm.
We've started looking at them. There's absolutely some very impressive features and functions. However, two considerations I would offer up to anyone. How are they financed? Because I would hate to find out one day that they don't have the balance sheet to support ongoing operations, because they are early stage companies. But we know Intuit is a public company. But two is, do we really think Intuit isn't going to continue to release additional AI related features?
Right, right.
Long way of saying we're very bullish on QuickBooks Online, and for the foreseeable future, that will remain our core platform that we advocate for, endorse for our clients. Second one is going to be your CRM. And so whether it's HubSpot, Salesforce, Copper, take your pick. One of the things that we find when we start working with clients is it sheds such a powerful light on the value of appropriately putting potential close dates on deals, stages on deals, and values on deals. The investors that I know who do Series A say, show me your pipeline.
Hmm.
That's great that your sales have been good, but what does the future look like?
Right.
How you're telling me you're going to continue to grow at 5% month over month, but show me the potential deals that are going to close that are actually get you those numbers.
It's a fair question, right?
Yep. And so ensuring that you not only have your CRM, but that you're managing it weekly. I mean, I can't tell you how many times we onboard somebody and it takes months to
Mhm.
finally get everything together. So source of deal is really important. And then third and final one I would just say is payment engine. Everyone doesn't think about cash until you need it. And so, HubSpot has their own payment engine. Salesforce does. We're big fans of Stripe. Stripe is very powerful. But I understand that it completely dictates on what the underlying product or service is. I would tell you most importantly is creating a set of pipes that connect all three or both, and then establishing a reconciliation process where you can tie all that activity out on an at minimum monthly basis.
Mhm.
So that's the underlying accounting platform. And then as far as reporting goes, um, I made reference to having one source of truth. What's in your accounting platform should tie to what's in your payment engine, should tie to closed won deals in your CRM. But then if your accounting platform doesn't already have robust tools, and yes, and QuickBooks Online has a suite of great reports, but they're predominantly accounting versus board reports. We use a host of third-party tools. I'll give some shout outs to two of them. We use Causal for modeling, and we use Visible for dashboards. Very unique platforms. We use Causal for our budgets and scenario modeling, and we do Visible for board, C-suite, and potential investor reporting. But the takeaway here is that I have at least one tool that gives you the ability to understand your business's performance and how to model out different scenarios and being able to communicate that. Last thing I'll say is there's no escaping Excel. Even though we're fans of these programs, the reality of it is a potential investor isn't going to learn Causal. Despite how intuitive the interface may be. I've never once seen, and I don't know how many rounds of financing we've closed now, every single investor said the same thing. Give me your Excel model. So I would invest in an Excel model. And on that note, I haven't mentioned this yet, Keith, but on our company's website, finstratmgmt.com, you'll see on there free CFO consultation. We'll post a link in here as well, but any of our audience who'd like to connect with one of our fractional CFOs, totally on the house, happy to listen and provide feedback.
That's huge.
Follow up this call. But yeah, those are really the core programs that we look to establish and maintain for purposes of setting a foundation for growth.
Got it. Sophia, another question?
We do. For now, it's like the issue with QuickBooks replacement is that most accountants or CPA firms are risk averse and will not want to learn or use the different accounting system. What do you think about that?
It's a good question. I think part of the answer goes back to what Keith mentioned earlier. It's just an appreciation that depending on where you are in your growth trajectory, is really going to dictate what platform you should use. Funny, not funny. When FTX collapsed and they were in front of Congress, someone said that they were using QuickBooks Online to manage the books. And I think there was an X media storm that erupted. Like, oh my gosh, can you imagine? So I think there's a reason why Intuit only owns the early stage market. As businesses mature, you're going to start to look at more mature, robust products. NetSuite's very popular. One of the reasons why NetSuite's popular is because it includes a roll-up function, whereas if you start to include different subsidiaries, it makes it really easy to consolidate those financials. Another competitor that we particularly like and will use is Microsoft Dynamics. That's a competitor, completely web-based, and it makes roll-ups really easy. But then, there's SAP, there's Blackline, there's a whole host of other very robust accounting platforms that you'll find in organizations that are doing, $500 million in top line in revenue, and that, they haven't built their own homegrown systems that they'll use in order to manage the close process.
Joel gave a big shout out for NetSuite. Christian, when in a company's evolution should they switch from QBO or whatever to something more sophisticated like NetSuite? Is there a revenue level? What's the trigger there in your mind?
Yeah, so I would tell you, usually if you're hitting about $100 million in revenue, odds are, there's some exceptions. Odds are, it depends what you're selling. Odds are you've outgrown QuickBooks. I would tell you more so than revenue, it's just going to be volume of transactions. So we have clients who are processing individual transactions in the thousands daily. And QuickBooks still works, but that's because we've established processes where we conduct all of our reconciliations within their standalone payment engines, of which the majority of our clients who are doing 1,000+ transactions on a daily basis, we use Stripe. I mean, Stripe is just so powerful. And their APIs are great for purposes of DevOps. But we'll do our reconciliations inside of Stripe, very robust platform, and then we'll port summary information into QuickBooks. And so coming back earlier is having one source, all roads are going to lead to your accounting, but there's a lot of different ways that this can be managed. As compared to if you had a 100 million company that was selling $10 million offerings and you only had 10 invoices a year, QuickBooks Online would be just, perfect in sending invoices.
Yeah. Okay. I want to shift a little bit. We've got exactly 10 minutes left. So coming to the end, feel free to drop any questions in the Q&A box if there's anything that anybody wants us to cover. But I did want to cover very quickly from the perspective of a capital provider, a couple of things that you as CEOs and founders need to be aware of when you're about to hit the fundraising trail. I talked about one of them earlier, volatility and metrics without a clear understanding, and being able to articulate why there's volatility. Like I said before, not everything is always up and to the right. Real life happens in a pretty chaotic way. Real growth happens often in a very chaotic way, and that's okay as long as you can explain it and articulate what are the dynamics, what are the drivers of that growth, whether it's chaotic or not. I think that's always a critical part of the conversation with a company when we talk to them, because what we're really looking for, and whether you're a lender or you're an investor, what you're looking for is predictability. An investor may be looking for predictably massive growth. A lender may be looking for just predictable slow growth, just safety. But if there's too much volatility, it's difficult to find that answer. So that is something that you're really going to want to understand and be able to articulate. And I think working with Christian and a company like FinStrat would help you be able to say, look, here are the key drivers that cause that volatility, and here's what we're doing to smooth that out.
Keith,
Another thing that we often see is we'll see companies, and in my days as a VC, we would see it too, showing up with very little runway. And that's always a challenge. If you need capital to survive the next couple of months, it's not a great time to get out there and start raising capital. Typically what you want to raise capital from the lenders like us and from VCs is really for growth projects, not necessarily to shore up the balance sheet because maybe the underlying economics of the business are struggling at the moment. And then another thing that I think Christian and his team are really good at helping with are understanding unit economics. If you can talk to your investors about what they're going to get when you put $1 into your machine, what's going to come out of the process, and really articulate value in that way, and really show them a unit economics model that describes the business, then you're going to be in a much better position when you're raising capital, because it's so difficult to understand that if the entrepreneur doesn't. So it's much better to have the entrepreneur say, look, here are my unit economics. Here's what you get for $1 when you invest it. And that's a complicated effort, but something that I think Christian and his team are able to help with.
One of the things and we didn't talk about this, and then only because maybe I make the mistake of assuming that it's such a common topic these days, but this concept of revenue recognition. So the AICPA has actually put out an accounting rule. It's called ASC 606. You may have heard of it. This specifically dictates how you can recognize revenue. In its simplest terms, it's accrual accounting, which you may have heard of, as compared to cash accounting. This part's really important, and I'll just use a very simple example, hopefully that drives home the point. But one of the things that we see when we onboard a new client is that someone sends an invoice for 12 months worth of service. They'll book all 12 months of revenue on the P&L in the month that they send the invoice, as compared to pulling 11 months off, putting it in deferred revenue on your balance sheet and peeling it off over the subsequent 11 months. Not necessarily the reason why there's volatility, as Keith is mentioning, but it absolutely can contribute to it if the revenue hasn't been appropriately accrued, because what you're going to see is a pattern of revenue that just mirrors when you close deals
Yeah.
as compared to when you earn it. Now, the other thing we haven't spoke about is, we're seeing a lot more usage-based revenue models.
Yep.
So, traditional SaaS, it's reoccurring, all things being equal, it should be the same amount of revenue over a given amount of time, notwithstanding expansion or churn. But with usage, as the name suggests, Twilio is a great example where it's really just, hey, when do you use it is when I recognize revenue. We often get asked, Christian, how do I tell a story about my usage growth, if it's seasonal, or if, my cohort isn't large enough to eliminate the variability that you would see. Great questions. One of the things, this is just tactics that we'll do when we're presenting dashboards, is we'll do like period growth. And so December to a year ago. And what that assists do is smooth out volatility that may exist if you were just to look on a historical trailing 12-month basis.
That's great. I think we've got a couple of questions, Sophie.
Yeah. So Andrea asked, do you have any suggestion for consolidation software? Sorry, I'm a little bit nervous. My first time, guys.
You're doing
And
great.
Joel says, Charby plus their RepRec plus integration with Stripe, QuickBooks, and HubSpot are lifesavers. Yep. So
We got
I don't know if
recommendations
you
from
want.
Joel. Okay.
Yeah. So if you want to dig deeper, go ahead, guys.
So usually the go-to is NetSuite, but I would tell you that Microsoft 365 is a bit more user-friendly, and in my opinion, powerful platform for roll-ups and consolidations. And that's our go-to. And
That's
then,
great.
yeah, the programs that were mentioned in the other question, agreed. There's a whole host of great software programs out there. I think more so, if anything, Keith, it was you were mentioning about, being dialed into your unit metrics. We haven't explicitly said it, but having a chief financial officer in that regard is extremely valuable, because that's their profession. Again, I acknowledge I'm biased because we offer these services, but our fractional CFOs shoulder the responsibility during board calls to support the C-suite in
Yeah.
being to unpack this. And so whether you're
Critical.
or another, I personally don't think it's completely reasonable for everything to fall on the CEO, and to be able to explain anything. And if you ever go listen to a public investor call, the CFO is sitting right next to the CEO, and they're unpacking the financials. And so, appreciating that, I mean, there's a lot going on there, that having that support is invaluable.
I think that's a great way to bring us to a wrap up here. We have 3 more minutes. Christian, any last thoughts about why companies ought to come seek you out and work with you?
Oh, I would tell you, I found that we're generally a great fit for founders who appreciate organization and structure and realize that their business is approaching a point where they need a foundation for growth. And the irony of it is I've been in this profession for 2 decades. I'm a CFA, a chartered financial analyst, charter holder. I have been since 2004, but my undergrad is engineering. And so consequently, it has served me very well for purposes of creating underlying systems that can support growth. But as I mentioned, please feel free to go to the website. You'll see there's a link for a free CFO consultation, or as you'll see here, Keith has put up my email. I think, Keith, if anyone's interested in learning about non-dilutive capital, I'll give you an endorsement right now. As Keith mentioned at the beginning of the call, we are a novel client, having been exposed to, I don't know how many dozens upon dozens of different due diligence requests over the years. Their platform is brilliant, made the process simple, and they were very transparent and easy to work through. So, this decision to join Keith today was very easy because it's just a great organization.
That's a ringing endorsement. I appreciate it. And that's the goal. That's what we want all of our customers to. That's the experience we want all of our customers to have. Yeah, for CEOs and founders out there who are seeking growth capital, and you're a B2B SaaS or B2B software business, definitely come check us out. We don't care if you're venture backed or you're bootstrapped. You could be either or both. I don't know if you could be both, but if you could be, we could definitely talk. Um, you can see my email address there. You see Christian's email address there. I can't give Christian a high enough recommendation either. Like I said, and like he just said, he is a client of ours, and we see the benefit of his work not only from the financials of Finstrat, but also from referrals that he's made. So if you need that kind of help, then I would definitely recommend reaching out to Christian. And if we don't have any more questions, then I will say, Christian, thank you very much for taking the time to have this conversation with me today. And Sophia, thank you for keeping us on task. And thanks everybody for joining.
Thank you, Keith. Thank you, Sophia.
Happy holidays, everybody.
Cheers.
Everybody.
Have a great one.